Cash out refinance versus a home equity line of credit, or HELOC as they're better known, are coming back into the mix as we see mortgage rates continue to start to come down, especially as we get into these summer months. Cash out refinances and HELOCs are going to become a topic of conversation. Look, if you're a homeowner right now or a real estate agent, you're probably already having conversations about, hey, should I repair or improve my home, or should I consider a move-up purchase or moving to that other great neighborhood that I want to live in? And so as we see these market dynamics change and mortgage rates come down, those questions are going to start to bubble up. And what you're going to do is start looking at HELOCs and cash out refinances relative to the costs of moving. Conversely, maybe you're a homeowner right now and you're noticing that credit card payments, because interest rates are going up on credit cards and credit card debt is going up, maybe you're noticing that all of a sudden the equity in your home can be used as kind of a tool against that credit card debt. Hey, and look, and the most obvious one right now is if you're purchasing a new car, financing on cars has gotten really expensive over the past several months, year. And so people are realizing, man, I've got to buy that car. I've got to be able to get to work, get the kids to school, etc. And using the equity in a home might be the best inexpensive way to purchase that car. So home equity lines of credit, cash out refinances, three things that you want to think about. First and foremost, obviously, the number one is that both of these products will allow for a lump sum of cash to be given to you when you close the loan. And that lump sum of cash can be used for a really wide variety of things. You can use it to pay down credit card debt. You could buy a new home. You could fix the bathroom. You can add a kitchen, build a pool, whatever. You could also, if you're really so inclined, take that super exotic vacation to the South Pacific and stay in a hut over water for a week. You can use it however you want. Number two thing that you want to think about is make sure you understand that both of these products use the collateral, the equity in your home, as collateral against the loan that you're borrowing. So it's very, if you're a homeowner, which you would be if you're considering these, it's very similar to how you acquired your home in the first loan that you put on it. But remember, we're going to be looking at things like FICO scores, loan to value, debt to income ratios as we evaluate the collateral of your home, the equity in your home, and how much you can borrow. And number three, the third item that you want to think about is these two loans are very different. When you do a cash out refinance, what you're doing is replacing your existing mortgage with a new one. Obviously, the new mortgage is going to be greater than the existing mortgage, and that difference is going to be what you're bringing home as your lump sum of cash when you close the cash out refinance. So the terms of that cash out refinance will obviously be fixed if it's a 30-year fixed loan or if it's a variable loan or a 25-year loan, but those terms will remain fixed. Now, when you look at a home equity line of credit or a HELOC, those terms are very, very different. A HELOC actually sits in second position or behind your existing mortgage. So you're not replacing your existing mortgage. What you're doing is you're creating a new loan that is subordinated or sits behind your existing first mortgage. So the terms of your existing loan remain unchanged, and now you have a new loan or a HELOC, and those have their own specific terms associated with them. A lot of HELOCs will act kind of like revolving debt, let's say for the first 10 years. So you can draw against the equity in your home, you can pay some of it back, etc. But most of them, when you get to year 10, will freeze that line of credit, and then you're going to pay it off over the next 20 years. The other things that you need to be aware of with HELOCs is many of them are variable, so their rates will adjust throughout the period. And then a lot of them will come with things like teaser rates, where to entice you to get the HELOC, you get a low interest rate, and then it increases at some time downstream. And then some HELOCs will also require you to take a minimum amount of a first draw, $50,000, something of that nature. So the cash out refinance and the HELOC are two very different loan products. One is the cash out refinance is replacing your existing mortgage, whereas a HELOC actually sits behind your existing mortgage. You need to understand how both of those work and how both of those fit your financial goals. Hey, I hope this helps give you a good introduction to a topic that's going to come to the forefront as we get through the summer months. As always, so appreciate you checking out my content online, and I hope you have just a wonderful summer. Thanks again.